Hello, everyone, and welcome to this new episode of the Fundraising Insiders podcast, the podcast where we explore what is behind the check and we put it inside the deck. I'm today joined with Bruno. And Bruno, you have, for the people who have listened to this podcast a couple of episodes already, you're starting to know we like to pick the oddballs out there, the non-standard profiles. Sure, a lot of VCs out there have been through Harvard Business School or maybe LSE, and they did a traditional economics degree or INSEAD. They go a little bit in investment banking, and then they start analyst, associate, maybe investment principal, partner, and they make their own fund. We're not about this here. We're about diversity. We're about the cool profiles, the cool careers. And you have something very specific. I remember in our introductory call before this recording, you mentioned your career was a portfolio career. So that's something that you'll tell us all about. Bruno, please introduce yourself. Who are you? What do you do? Because there's a couple of hats that you wear. And how did you come to do what you are doing today about your career?
Thank you for the invite, Thibaut, and thank you for having me here. It's a pleasure to be here. We've met now a couple of years ago now when you had a startup and I was mentoring for MassChallenge, a new masterclass in fundraising for MassChallenge in Switzerland. And I have an amazing good impression about all the activities that you did and you are doing currently. I think it's going to be a super interesting talk. Starting from the intro side, I now have, not to call my age, but shy of 35 years of experience.
It doesn't look like it.
As a structure, thank you. I started as an engineer, and then after that I did a postgrad in finance, and my intention was back then to do a strong MBA. What I call a strong MBA was to go to Harvard, INSEAD. But different paths went through my life and different things came forward, and it appeared that I started working in multiple jobs. So I was teaching in university, I was doing questionnaires in the weekend for the European Union, and I was a quality engineer in the workday. So I had 3 jobs into the same week. This after I had done an internship in Nissan in the UK. So that led me to think that to acquire skills throughout your life, I would rather grow almost in the oblique way than in the diagonal way, I would say even, than into a vertical or an horizontal form. So that's what I've planned for myself. So after working in a company that was acquired or that was a joint venture with ENI in Portugal and doing natural gas networks, either programming and doing telecom networks and infrastructure in Portugal, I moved to Philips in Spain to work in lighting, in the commercial part of lighting, where I was first the key account manager for Portugal in the OEM, original equipment manufacturing lighting business. So it was a business to business approach, and then moved further into the structure. I moved to the Netherlands. I wanted to move to a global business that was more macroeconomic focused in lighting. So I moved to semiconductors, where I spent 3 years, where I was between the Netherlands, China. I had clients in Korea, in Turkey, and I could see the world in a different form. I was a product marketing manager for Philips Semiconductors. That doesn't exist anymore. And now it's NXP. It was sold by Philips, and it was sold again, I think, recently by private equity. And after that, I moved to do, because Philips in corporate, you work through bands, and I had a band X, and I wanted to move upper, and there was an opportunity to do what they call a black belt project, and I moved to be a black belt in client services for Philips, and this position was based out of the UK. It was a position that had a lot of interaction with the US, and led me to create my first small company, and this was talking about 2005. So I created then an e-marketplace to resell used goods for Philips. That was already polemic back then. It still continued to is because of the margins, the hidden margins of the big retailers, the Amazons of this world, and the return policies that they have. But from that point onwards, I started basically thinking differently, and I wanted to add another sector, maybe keeping the same line of functions. I moved from there to the Netherlands to work to Netherlands back to work into Cargill and to be a marketing manager for the agricultural and biofuels business of Cargill. The business unit back then, one of the 12 13, 14 business units that Cargill had. Cargill had divisions, it had platforms, and then it had business units inside of platforms. But in all, I think they had more than 40 business units, and they had 7, 8, 9 platforms. And I was working inside of a platform that aggregated the agricultural, transportation, business units, and I learned a lot. Based out of the Netherlands, basically my range of action was from Turkey to Portugal, from Norway back into Italy, so all Europe, continental Europe. I traveled a lot in Europe, learned a lot, learned agriculture, deep agriculture. After that, I moved to Switzerland to do a little bit of the same, but in the higher level, so at the platform division level, for a platform that was energy transportation in metals. After that, I moved and did something closer to the market, did more business development, something more in structure finance, based out of Geneva, and then a little bit out of the US, also do the markets in Central America, do some markets in Africa, do Latin America, structuring of deals between what is energy, what is transportation, and the advantages that the company had in the supply chain. This is until I was around 40, I think the journey of going in a tangent of doing different things in different tasks was more or less completed. So I thought that it was time also to go and to go back. And I stopped my corporate career when I was 41, 42. And I created my second startup. My first I had created already when I was in Cargill, based out of London, a startup that was taking advantage of augmented reality with free friends. And, we lost some cash, but it was a super interesting experience in 2008, 2009. And the second I created inside of Shell. That's a company of advertisement and publicity of Samsung. And I did a startup in data analytics together with a friend for sports. It was an interesting ride. Then Shell didn't want to continue with the process. And we also thought that we didn't have enough backup. Imagine that we are talking about 2014, 15. AI was something.
So very early.
It was not what we are today. It was a completely different cost of ramping a company. From then, I moved to advise a person in an institutional sport organization in the Middle East. Back from that job in 2016, end of 16, beginning of 17, I started looking again for jobs that would continue my path in terms of the learning. But I really back then knew that I wanted to work as an investor and I wanted to go into the ecosystem. It was not easy to get in because when you are coming from an operation standpoint, even if you are an entrepreneur, this and that, or you have made an exit and you have an amount of cash to place and you rule the things in a different way, or if you want to get in and you didn't have experience and exposure to investment, etc., you need to do things in a different way. So I got a job as an operating partner job inside of a company that was bought by Apollo in France. I moved to Paris and started working in there. When I was doing that job, some months into that contract, Cargill came knocking at my door again. There was a person that I knew from my network, great guy, that was asked to go back to Cargill for his network to restart. He also left Cargill, but he was asked to go back to Cargill to restart the corporate venture capital activity in Cargill. And he was completely not in the ecosystem. And I was in the ecosystem. I was mentoring already for Techstars, from MassChallenge back then, 16, 17. Because of the startup that I had created a lot of contacts in that area and immediately said, yes, let's do this. The only thing that happened was my surprise when I arrived back into Cargill and I saw that we were not alone. It looks like the alien situation when you are in the country and you go to a new planet and you say, oh shit, we are not alone. There's a lot of people around. We were not the only ones doing the CVC model in Cargill. Cargill had gone through a process of restructuring since a little bit before I left, it was already started, that Cargill got off its positions in different real estate asset management funds, different hedge funds or multi-funds, as you want to call it. And those were the ones that potentially were tailed to drive the investment in CVC since the years 2000, end of the 19th, where Cargill had a lot of activity in that sense. But nothing was done in a strategically fit way.
So already inside Cargill, there were other CVCs or other structures that were starting to resemble CVC, maybe not in the same direction, and you had to fight your own place within the company.
Correct.
So that your branch would work.
Cargill, Cargill had, in that moment in time, still 5-6 platform divisions. And inside of each division, they had, let's put it this way, an average of 10 business units. So when we went inside, you always try to establish a strategy for all. But then you see that Cargill Salt had its own CVC ideas and was executing already. You start putting all those 3-4 businesses aside, then you start agglomerating the other ones that are not these ones. So that's what we did. And we started putting together a process to approach the CVC model. 2 years, 18, 19 was a great 2 years. Then in 2000, in the year of the COVID, Cargill decided finally to consolidate the project. And the consolidation was made by a third group that was not active in doing the investments, but was active in what they call corporate strategic development. None of the 4 groups decided to continue. Cargill nowadays focus much more in the US in terms of venture capital.
Right.
So after Cargill, with the experience gained, I start contracting independently. I did that for a couple of different funds in Europe and Israel, and I started acquiring some taste for board advisory roles. So non-executive directors, board advisory roles, paid board advisory roles, because you can imagine in my position, I have a lot of offers of those type of, I give you percentage, you advise me, or I give you percentage on the future raise. And it's not that, it's more like an employee, but being in a board advisory for the CEO. Right. So retainer, potential percentage of, so it depends on the deepness that the company itself wants to go.
Structure changes, right?
Exactly. Yeah. So I did a couple, and I still do a couple of those. And meanwhile, I moved, passed through the UK, passed through the Middle East, through Malaysia, and I moved, and I'm now between Lisbon and Berlin, living, and I'm doing contracts like this. Forgot one step is what the step actually in the CVC. It's for the venture builders hype that they are today. Right. So that the person that was in front of the corporate venture builder of Cargill, he asked me if I could also do a contract with them in order to advise the full board and to build the companies with him and the team that he had. And I did still that contract in the venture builder where we built it. Different amount of companies from the US to India, Europe, Africa. We did a lot of build of companies for Cargill. This during the end of mid 22 to mid end 23, and then then we're contracting different types of contracts.
So not only you had a venture builder role there, but it feels like you're also, I don't know if you can call it like this, but you've also done some venture builder building. Because you were also assembling the structure that was then taking.
I call it venture architect also. So I did a job of venture partnering for the corporate venture capital, where basically we did all the strategy and the deployment, the ecosystem creation, investments, and then we went to the process of doing venture architect. The venture architect was more managing the company that we've created while also investing, but with the cash that we were giving as budget to make it more profitable. I gave a little bit of knowledge to other founders, being in the board of the venture builder of Cargill, together with an amazing team. And then beginning of 2020, the end of 2023, Bidra, that's one of my main contracts today, and where I occupy a majority of my time, had a restructuring in the fund, and person that I know for some time and that I have a lot of confidence in took over as MD, as CEO in the US, and we were in contact, and he asked me if I could do first the job of advisor, then a venture partner role, and then potentially jump into an operating partner that in VC is different from a concept of an operating partner in private equity. So it's also due to advise investments, fund the funds, operate a little bit more widely the fund, constitute ecosystem in this area. And I said, yes, of course. And it's occupying large part of my time together with the boards that I do for different companies. I already do this type of arbitrage between the different continents. And there's a lot to be done still. And for Bidra, just to add and to terminate, for Bidra, I'm for 1.5, 2 years working Africa as well, more intensively than I was before, although I touch it, but much more intensive. And for the OCP in general, there's a lot of opportunities in Africa to work, and the nearby future will bring more opportunities. And I think it's a great, it thrills me and excites me of the huge opportunities that are, and the people in the continent across the 54 countries, the huge opportunities that continent is still has, and it's going to bring, and how is it going to grow in the next years to come?
Right. Yeah. I mean, you have such a extensive career. Let's try to break it down and summarize it in a couple of big arcs. The traditional corporate part, and then you start founding your company. And this is when, let's say, the virus started to propagate inside you of wanting to build something. And then this translated to building within the corporate and then investing. And eventually this kind of caught up to you and you start to build the investment platforms themselves. So the investment platform within Cargill and then now acting as an operating partner within Bidra. So it's very different from the kind of profiles we could see in other more traditional VC. Now, because you've seen both and because you've been acting in both, I'd like to have a bit of your vision about the differences between VC and CVC. One of the things we discussed in our pre-recording call was the different types of CVCs. One may think if you are the CVC of company A, the CVC is only going to invest in companies that are going to be bought by the mother company. But that's only part of the vision. Some CVCs are purely financial. And you mentioned the difference between a strategic CVC, a financial CVC, and a hybrid CVC. So could you please run us through the difference between those three, which ones you've been involved in, and the key differences, not just about their structure, but as an investor, the different things you're looking for, because you might not be looking for the same kind of things, not for the same project, the same returns, investments, etc. Tell us more about the differences between both, or between the three.
So let's pick up your first point between VC and CVC. CVC is a corporate venture capital. CVC, I think, as something as C plus then VC is the way that corporates potentially deploy engagement in the ecosystem through investing in business development. And this part of the second business development part can be done in the form of value sharing contracts, can be done in the form of business development projects, can be done in the form of joint development agreements, can be done in the form of LOIs, can be done in the form of full pilots for all of this and above. It's already different than only investing. So a CVC by nature, a strategic arm for a corporate. The question is that there are some CVCs, and now let's put the way that the CVC is structurally, legally, from the strategy, let's turn that apart.
Right.
Everybody knows that innovation in cycles drive profitability of product. How to do open innovation and how to do disruptive innovation, there's different ways of doing it. CVC being one of the main factor at the moment because you can engage and potentially make things happen in a different way around your ecosystem. The strategic CVC, it is a CVC that's positioned there between attached to the innovation path of the company or attached to the leadership of the company in the different business units, divisions, or whatever the company is evolving, and translating what's outside in the market to the inside needs and translating the inside needs for what's outside in the market. So it's a kind of a dual translation entity that has a couple of people in the CVC that understand further what is investing, how to manage a portfolio, but at the same time understand and want to get deeper understanding of the different businesses that the company has.
Right.
Not to say that consultants are a good fit for this because of, I know that the consultants get a quick understanding of the businesses, but then there needs to be execution and there needs to be operations on holding the portfolio companies in its portfolio, and there needs to be decisions to be made. And I think that for that, a huge business track record in experience is required, at least in my opinion, because there are ins and outs of the companies, ins and outs of the interactions with founders like you that you value, and you need to have passed through it, or you know from a different angle an experience of the business, how to scale a business, because have passed through it.
Right.
So getting back
there needs to be an executional, operational part to the people who work in the CVC. It can't just be understanding the business or investing in the business. There's this third dimension that comes in.
Correct.
Right.
In my view. So my view that it needs to be that third dimension very much so. And if businesses are linear businesses, so straight sales, business to business to consumer is one thing. If business involves a lot of technology is a second layer. Even if technology comes into businesses that are linear business, it can be that there was a business done sell to distributors all its life, and now it's replaced by a business that is technology driven. So you need to understand a little bit about the underlying technology. You need to be open to new business models that sometimes it doesn't happen. So you yourself as an element of a corporate venture capital or as a venture capital element, and we'll go back to the differences in 1 second. I think one of the big skills or characteristics or whatever you want to call it is information. Nowadays, it's much more easy. You have AIs, you have the bots, you have everything that you can use, but it's still, you need to be on top of the information. You need to get information from selected and quality sources. You need to share information with selected quality sources, and you need to act upon that information and take decisions. Be in front, where the things maybe are going to happen in the next second, but you already know. So try to understand trends, try to understand the way of thinking of clients. So there's a mix of tremendous amount of elements that don't only require seeing the numbers.
Right.
To see the numbers, and let's go back to the difference between the corporate venture capital and the venture capital. So usually when you found a venture capital fund, you do fundraising. You not usually have all the cash. So you have a 100 million fund, VC fund. Even if you have a GP commitment of 1 to 2%, you have to fundraise the other amount, the other 98%. So you go to the market, you need to make a promise, or you need to make a provision. And that's what you say, okay, my fund is going to be ERR 20% is going to be on the first quartile of best funds, is going to be this, is going to be that. So you make a promise. You don't have a crystal ball to understand exactly if it's going to deliver that. You try to convince the market, if you are a good salesman, that you are going to execute what you're saying well, and that your fund is going to deliver what you say to the market within the model, within the area that your fund is going to be. Correct?
So in that sense, it's more similar to raising funding as a startup.
It's more similar at raising fund as a startup, although with the startup, you see it much quicker in action, because with the startup, and you have a value. Usually the startup, the most significant value, you have an IP that you say, okay, you are investing in IP. So even if the startup doesn't go, maybe we can spin an IP to first. Or you are investing in talent. You are investing in the different type of team. You have a factory. You have a truck. You have assets. In a fund,
until there's an exit, there's nothing.
Venture capital, so you have a partition of the fund. You don't even buy yourself with an LP check a partition of the GP firm that managed the fund. You can, but you usually don't. So what you buy is just an access to that fund in particular, investing in that fund in particular, and you can negotiate or not your fees that you spend on your check. If you put $1 million of check, you usually get 2% out of fees. So you have to make a calculation that to be profitable, the fund needs to be at a certain level. And then, as you know, there's no liquidity. That means that the ticket is going to be there for the lifetime of the fund. Of course, there can be secondaries, that can be a lot of things, but in principle, there's no liquidity. So there's a lot of ins and outs of investing in funds that you need to be aware. That with startups is a little bit different, because with startups, it rotates much more. There's secondaries much more. You can sell it internal, external. With funds is a little bit more complex than that. VC funds, private equity funds. So the class of private equity funds that has VC funds inside, corporate venture capital funds, when they are legally independent. Because a corporate venture capital fund has two forms of, as we separated the structure from the strategy, 2 or 3 forms of being. So the most common are, or they out of the balance sheet. That means that they invest in the balance sheet of the company. It's positives and negatives, or they are legally independent. And when they are legally independent, also there's 2 or 3 ways that the fund can be structured upon. That can be a greenever, that can be a closed fund. Then you establish the rules of that. It can have one LP, can have several LPs, even it being a corporate venture capital. But the main difference, go back to the main differences in the different classes of CVCs. So VCs are usually financial instruments that you need to deliver.
Right.
There's some leverage that you can have, but there's different type of ways that you do VCs as well, but usual financial instruments. In corporate venture capital can be considered the financial numbers can or cannot be the first of the priorities or the second or the third. If it is a financial corporate venture capital, might be that there's a company that the corporate venture arm invests that they want to engage, and then they need to talk. But the corporate venture capital invests. and then go behind it. They don't need to ask. They don't know the business that amazingly much or what is done in the business. This is the financial way of doing corporate venture capital. Then there's the hybrid. That's a balance between strategic and financial more. And there is the strategic way that it's a long-term thought. So you are thinking long and you are always engaging companies, doing a pilot before, during, or after. Or you are doing more business development projects than you do investments, and you are engaging in a strategic way. And it serves also as a learning platform for people from corporate to come and go and to pass through it. And you are very much the investment arm, although you are not an asset allocator, but the investment arm of the company itself across the company.
In that sense, you have lived the operator part and the investor part. As you say, the CVC has those three dimensions you need to juggle between the strategic planning, the operational aspect, and the financial aspect. Coming as an operator, did you feel like you had a specific advantage in the CVC field because you had this experience as an operator? And is this something that you think should also appear in the VC ecosystem? So that's question number one. The question that follows is, now as a founder, knowing those kind of things, how do I address a VC versus how do I address a CVC? Because they want different things. So I need to present in a different way. So let's try to understand this a little bit. First, your background and how it fits. And then for a founder, how to address you, whether they address a VC or a CVC.
I think regarding the first question, it is a total advantage when you limit your work to areas of your knowledge, i.e. areas where you have grown businesses, have participated in business for several years, not for 1 month or two, like a BCG guy inside of a business. No, several years, saw the ins and outs of the P&L of a business and drove a country or drove parts of it. And then you act and you limit yourself to those business. I do that. I limit myself to 5-6 areas where I was lucky enough to have being in business, participating in business. I understand the business inside out, from logistics to the financials to operations, what's needed to the industrialization part, everything. So to the need of capital, to the need of underlying capital, etc. So that's point number one. Regarding the point number two, I don't think the two questions are too much related, because point number two, when a founder raises, in my opinion, and when a founder goes out and raises cash for a seed or for an A or for a B, you need to do an adequate planning for what you're doing. And sometimes that's one of the issues that the founders have, because they never did that. Usually first-time founders and sit down and say, okay, we want to raise cash. Let's contact everybody that we can, or let's contact everybody that we know, without having a concrete plan of engaging somebody, talking with somebody, and let's do a plan. What do we want? How much do we want? When are we going to raise? Are we going to raise now? We're going to raise in 18 months. We're going to raise in 24 months. What are we going to raise for? What is the kind of KPIs that we're going to achieve between now and when we're raising? Are we raising in the right timing now? Are we achieving what we need to raise, what we need to do to raise this type of round now? And all of this, I think, clashes against walls. In the deep tech area, and I give you clear examples, in the deep tech area, companies that live out of grants until TRL 3, TRL 4, I think those companies need to start engaging, even if it's not for raising capital purposes, but it needs to start engaging with corporates in their areas, because corporates are going to be the leverage board for their scaling in the future. Even if they cannot expect that they engage with a corporate and after 2 or 3 months, they need to start working on these relations much more before, because the nature of the company itself to scale companies in agriculture and energy, and they need to start much earlier that engagement, in entertaining that engagement, socializing that engagement. The founders need to have a kind of a clear vision where they want to take this, because for them it's going to be a journey, but for the corporate to entertain that inside, to do the business development projects, etc., is going to take a lot of time. So this time needs to be reflected in when they do a planning of fundraising. And that planning needs to be very well prepared. And nowadays, still with the amount of information that we have, we see a lot of startups in seed, early stage, raising, shooting everywhere like a machine gun. They need to understand, they need to engage people or try to be with people in the ecosystem that know that area, know fundraising, and start understanding the value, where they should take it or not. And this comes also from the exposure to correct incubators, accelerators, the MassChallenges of this world, etc. That educates them to do that. Of course, there's always a balance, because to do that, they need to lose equity to some at the prices that they would not like to do it. But that's the way that the world is organized at the moment.
It's interesting. You're saying that a relationship, especially with a larger corporate, needs to start as early as possible because it takes time, because the intrinsic format of a corporate is like a super tanker. You don't steer it by just turning the wheel. You have to anticipate everything. It takes a while. Often you will hear, and I have given this advice myself to companies, that it's always good to start to the big guys, because the big guys will give you a general direction. They give you the market trends, and you will need them at some point. But you should also engage with the smaller players to start generating revenue, as a corporate is not going to be your first buyer, because maybe their minimum order requirements are in hundreds of thousands of units and you can only produce 10 or 100 in the lab scale. So how is it that you advise a startup to engage both? How do they balance the engagement between a big corporate and smaller companies without losing all their time with a big corporate and thinking, I'm going to focus all my attention with Cargill, Nestle, P&G, and then they realize we spent 2 or 3 years talking with these guys, but we're still not going to make a revenue from them because we forgot to do the smaller steps before. So how do you balance those?
Nobody said it's going to be easy. Huh? And nobody said that AI is going to sort out every problem that you have. And that I think people need to start being aware, because there's a lot of things being done in the very strange way. The story of that guy that was coaching, and the Spanish guy that was coaching in Russia and managed his coaching through AI, the guy that was an ex-Barcelona player. And then they found out that he even was planning the trips through AI, and that the time zone in Russia completely screwed up his planning because he didn't put that in the AI model. Anyhow, so there's a lot of things that you need to think with common sense, and you need to engage people with common sense. And that's where a founder starts also being notoriously good or bad. It's where he engages the ecosystem and engage people around him or her. So the people around the ecosystem that he engages, or they engage for the advising, don't necessarily need to be a white hair people. Don't necessarily need to be a white hair in terms of being very old and having experience vertical, but need to be people that are wise in the ecosystem. In this wiseness in the ecosystem, and also ethical people, because there's a lot of fraud out there. People that are wise in the ecosystem, and things that people can do for other people when they are wise at the ecosystem, is multiplying by 10x the speed of acquisition of some knowledge. And this is not AI knowledge. There's a lot of the other day we were talking internally with some people that we now have. Not students, but people that from the business that are staying for 2 years inside of our CVC in Bidra. And we're talking about ins and outs of what is to do venture capital. And it's quite quiet. And then in the end, they asked me to talk. And I said that there's a word that was not referred during the talk there. That's a word named creativity. I think creativity is super important. Having the right creativity in the right place at the right time, and knowing what kind of creativity to have, gives you a different type of looks nowadays in this ecosystem. Don't want to be a smart ass, but also don't want to be the most quiet person in the room. Want to act in just the right time, in the right place, in every circumstances that you are in. And you need to understand that there is an important point to be, and you need to know what you want. That's one of the difficulties that I have with your generation. And the generation nowadays is 9 out of 10 people that I ask what you want. I don't know what I want. I don't know what I want. So it's kind of please think and reflect. Thinking is for free. Still, reflections are free. Reflect a little bit. Be courageous on reflecting upon the different things. And people need to reflect a little bit more nowadays. That's my take. They don't need to trust just the Instagrammers and the influencers of this world. They need to reflect much more upon what they want and the things that they are doing, and trying to understand also the surroundings that they have, and be curious and reflect. Two things that people do too much is travel for nothing and believe in Instagrammers or influencers for nothing. That kills me sometimes. But anyhow,
you mentioned advisors as being a very key thing here. So people who are in the industry, who have the knowledge. So referring to the original question of how do you balance, let's say, your go-to-market strategy, because it's really what it is, between going to a big player or a small player. I suppose it varies from ecosystem to ecosystem. Some big players in some industries will move a lot faster than big players in another industry. So this is where you advise something very pragmatic, very empirical, where someone who has done business in that industry will come and tell you, those are the guys that you need to target for your first dollar. Those are the guys that you need to keep in mind for making revenues in 2 years. Those guys, it's going to take 5 years to get a contract.
My point, try to decide for yourself, try to listen to a couple of different opinions and a couple of different advisors, but have always your own decision. And don't have paradoxes in your mind that the guy with the gray hair is the guy that knows everything, because the guy with the gray hair can be a guy that's already retired, and that is the way that he thinks is a completely different way, and he's doing that for some reasons. And the guy that is the young guy, or the guy that is dressed in a strange way, then he can be the one that gives you the right advice. So try to listen, equalize, common sense, information, experience, shaker, and then issue an opinion, but issue one. Not surf on the opinion around and around in circles. So issue an opinion and make a plan. Make a plan how to go forward.
It's something that is coming back a lot in our discussion. You mentioned planning, and there's the dimension of execution. You mentioned a lot that the creativity comes in the planning, but there's also creativity in the execution, the way you execute. Where is it that you feel more comfortable? Because you've done a lot of planning, of creating, how to create a venture builder, how to create a business, etc. And then you have the execution part, which sends back to your operational background. Where is it that you thrive the most? Which one is it that brings you the more satisfaction? The planning phase or the execution, deployment phase?
It gives me the most excitement when I execute things that I plan.
Okay.
I like when I execute the plans that I concur from the other ones, but when I plan something and then I execute something that I plan, you have creativity squared. You have creativity, as you mentioned, in the planning, and then you put your own personality, because it's personality and profile, in the execution. In both, sometimes it's really a huge, what they say, huge kick when you do things. And I like this. Do it for an obligation. I have a lot of enthusiasm in doing these things, and I like to construct. You need to like to construct. It's not only throwing things against the wall and then turning your back and going somewhere else, and then coming a couple of months after and seeing what the things are down from the wall are still holding in the wall. No, it's liking to construct and assuming your own constructions. That is something that I really like to do. One good advice for people, either for managers, either for people that are starting, is that both of us should allow space for mistakes. Of course, within the certain parameters.
Right.
People that are starting should not be afraid of committing mistakes. Of course, should equalize them with advice, but should not be afraid, because it's from mistakes and from being in down cycles that you learn the most.
It's really what they call the fail, but fail fast. It's not about failing because you will fail. It's about
you want to
speed
fail,
at
but
which
you cannot. You cannot. Sometimes you are failing. You are giving the responsibility when you are in the right time, in the right moment, or in the wrong time, in the right moment, for a reason. And you are giving the responsibility, and sometimes people freeze on that responsibility. But you should think about that is a good opportunity to do something and to construct. And then if you fail, or if you fail, just put it in your mind. Do something. It's better than do nothing. Do nothing is a total failure.
Right.
Do something. If you fail, it's life. You cannot get everything right.
But at least you learn. And well, you of course have to do a balance between the resources you put into something that could be a failure. So weighing the pros and cons, of course. And we are back a couple of weeks later, meaning we also had the time to reflect on some of the questions earlier. Don't worry, I remember where we left off. I'm wearing, as a matter of coherence, I'm also wearing the same outfit. The shirt is a different one. It's clean. And Bruno is still with us, joining from his phone because of other technical issues. But this is the whole startup vibe. This is the whole entrepreneurial spirit. And I'm doing a bit of a time bending right here, because I know that this will be published as episode 8, but I've already recorded and edited episode 9 that will come out later in the week or next week when you're watching this, speaking to the audience. And these two will have a couple of technical issues, but it gets better in the future. And it's the whole point of a company, of a startup, of this whole thing. We have problems, we adapt, we have a problem, we find a solution, and in the end, it all works out together. It all works out great. So we are back, and we were talking about financials. And as a founder, approaching VC capital versus approaching CVC capital takes a little bit of adaptation. You need to do things slightly differently. So, Bruno, please welcome back, first of all, and tell us a bit about the difference in a founder, how we should approach a VC versus approaching a CVC. What are the differences here?
Hi, nice to be back, first of all. And then totally agree with you. We need to be resilient, facing all the circumstances always. It's not a linear path, and we need to constantly learn through everything that we do. I like the approach because humble people will then have also around them better people, in my opinion. So getting back to the point that you were saying, first of all, the difference between the investments, the capital is the same, dollars, euros, the capital comes from a bank, is the same type of capital. But right. The capital comes with caveats. Usually the financial, that means that it's a financial investment and the financial indicators come on top of everything. They want the company to succeed. VC, what's a VC objective? All in all, it's look for outliers. So looking for outliers, 1 in 10, 1 in 20, 1 in 50, depending on how the portfolio is organized. But looking for outliers requires that a constant push to financial indicators and to management indicators, but not financial indicators, depending on the stage of the company and on the influence of the VC in the cap table, in the capitalization table. Where are they? If they have a 2%, a 5, a 10, a 15, they have a board seat, they have a board observer seat. Right. So what is their position? And in terms of a venture capital could have different strategies, but as my experience tells me, they are always more composed or more structured than a VC strategy. Examples, a venture capital can invest and at the same time pass a side letter where it pushes the company for joint development agreements, for LOI.
So that's for a CVC, you mean? For corporate venture capital?
For a corporate venture capital.
Right.
These are all actions that are common in structuring a deal. So pushing the company for more strategic obligations like doing a POC, a proof of concept, a pilot with the corporate, that's the sole LP of the CVC behind the investment, fronting the investment. Right. That comes from the natural objective, it comes from the natural objective of a CVC. That's a CVC is the front end of innovation and needs to leverage being the front end of the innovation, then composing the portfolio with different type of investments.
So that sounds like mainly an advantage. So the follow-up question naturally is, are there also disadvantages or things to be careful about when taking money from a CVC, and what would those be? How do you prepare for that?
There essentially, in terms of legal incorporation, there are two types of CVC. There's the ones that are out of the balance sheet, i.e. inside of the company that receive allocations from the balance sheet of the company that are not a fund per se. They can be, but they're usually not. And there's the ones that are legally and independently incorporated as a fund. Usually the second example are quickest in executing a deal than the first example. So the expectations for a founder point of view are also in terms of time. Founder is always doing things for yesterday. They need cash yesterday. They need support yesterday. So be aware that the CVC, in average, the legally independent ones sometimes act as fast as a normal financial fund. But the ones that are out of the balance sheet, incorporated inside of the company, are depending on legal counsel of the company, are depending on all the proceedings also of the company, and have an IC that is not a professional or standalone IC, that they have completely different type of tasks.
Gotcha.
To get that IC together, it takes some time. It's between 1 or 2 months, in between 6 or 8 or 9, and between the approvals that's needed to execute that investment according to the process and according to the compliance of the company if they are inside. There could be also compliance outside in processes, but usually they are more quick than the ones inside of the corporation.
I understand. All right.
So this
So
is
that
one
close.
of the points. This is one of the points that is very, very important. The management of expectations. But of course, there is some equally points for the two parts. So usually this point that we refer in the beginning, the push for POCs, the push for GDIs, the push for information rights, further than the ones that come in the incorporation of the company. All of that is equal because you would need to see the CVC from a corporate angle.
Right.
Hence, you see a venture capital financial firm that's an agile firm, and the only thing that they are looking is for outliers and financially outliers.
Gotcha. All right. Thank you for this distinction. Now, let's move to our flagship structure, flagship format in the podcast, which is the this or that. I know it's a super creative title. I'm going to ask you questions, fast-paced, and you will try to answer with only option A or option B. So, for example, one of the question is, do you think it's better to take a warm introduction or a cold email? Let's try to go only for one of those two. You can say both. Sometimes you can say both or none. It will happen. In any case, we'll keep the explanation for later. So if I feel like you are hesitating or if the answer is not as obvious as it could be, we will keep that for the discussion right after this. All right. So let's go. So let's start with this one. Warm introduction or cold email. What do you prefer receiving as an investor?
Both.
Teaser deck or full deck for the first point of contact?
Teaser deck.
Do you put more importance on the founder story or the market size potential?
Depends on where the company is at.
Now, as a founder, would you rather take CVC money or VC money?
Depends when the company is at again.
Are you comfortable with a fractional role like you are today, or would you be looking for something more like a full-time role?
Both. I'm very comfortable. The flexibility is the wording here.
And speaking of that, in a company, would you think it's better to have a full-time person on the fundraising with the CEO, or can they take someone fractional to support them in that task?
It depends on the stage. If it's after Series B, I think an investor relations is essential. But if before Series B,
Okay.
Series A, I don't think that should be in the books for the company. It's an extra cost. So a fractional person should do the trick if it needs a fractional person, because the founder himself and the CFO should do that raise.
Okay, perfect. Now, what is your preferred domain to invest in, ag tech or deep tech?
I like both. My preferred domain is to invest in domains that I have knowledge in. I'm
Okay.
totally pro of having developed or created or managed business in the domains that you invest in, that you know the ins and outs of that domain, and just not being parachuted in that domain just because it's fashion or it's happening now, or you think you want to work in VC.
Right. And now, hardware, software, which one has a special place in your heart to develop or to support?
Data. I love data. So data,
Okay.
I think, is something that is nested in the hardware through software. Recently, was having a conversation with Microsoft about encryption, and hardware encryption is very, very fashionable now. In software encryption is less fashionable. So the way that data is encrypted in the different parts of the system, it's great. So my preferred item of the ecosystem, being hardware or software, is data. I'm a data
very
person.
interesting. Now, of all the regions you worked with, EU, US, Asia, Africa, which one is your favorite market to invest in and then to raise from?
I think that the best ecosystem in the world, without no doubts, is the US. Overall, from a fundraising and an exit perspective, is the most mature one. More than 25 years of doing exits, IPOs, etc. Europe, I think, currently is the third ecosystem in terms of numbers, is an interesting ecosystem to act on because we have a lot of early stage technology that in the past went directly to the US, and now we can try to make it work in Europe. Although we are in a complicated area because we have 27 plus 2, 3, 4 legislations here, and tax systems, not only legislations, tax systems, etc. In the US, has 50 states that cannot opt in or out of federal policies, and it's much more easy for them to scale.
Let's see, which one you think is raising at the faster pace and people might not be seeing it if they don't have an insider knowledge about it? Which region?
In Europe or in the US? Well,
In
around the world.
globally, do you think there's a region globally that is growing at a specific pace that maybe is going under the radar?
India is a tremendously growth market at the moment because doesn't have the restrictions in capital as China. You can invest in an outside investor, although you need to create a local entity, but you can invest, and it has tremendous amount of technology and brain power. I think
Gotcha.
India is the greatest growth market, but China continues to be, as a mature market and in scalability, the best in terms of growth of scalability. Not maybe the
Right.
growth of new technologies, but the growth of scalability, maybe tech transfers, imitating things, etc. China, because of the non-restrictions of IP sometimes and of,
Right.
but continues to be the best market for that.
Okay. If you were an investor, would you place your money more on solo founders or co-founders?
Definitely co-founders and definitely not husband and wife. Romantic relations between founders are something that I don't necessarily like as an investor. Especially if I, for instance, give you an example, if I'm investing in funds, I think the solo founder GP or the solo GP is something that people should consider very much. So the risk
Okay.
of a solo GP is very high for an LP. There's a
Gotcha.
huge amount of risk there.
Gotcha. Would you say there's more risk for a solo GP or for a solo founder of a startup?
In terms of an LP, if I place my cash on the risk for a solo GP than a solo founder, because a solo founder needs to surround himself by different type of functions, and the company needs to ramp it up to a different level. A solo GP is really a solo GP because he lives on management fee, he cannot surround himself, if he's solo, not by other partners, but by other principals. And usually he concentrates too much power.
I see. Let's see. What is more exciting for you, to fundraise for a fund or to invest in companies?
Two completely different things. I think nobody is excited on fundraising for a fund,
Okay.
especially in the current markets. It's very, very challenging. Although it's very exciting to have the proper fund that represents your idea and to deploy it with the right strategy and do the right portfolio management. I think
Gotcha.
those are comparing apples with oranges. Of course, the second is better than the first.
Gotcha. And finally, what do you enjoy more doing, building a strategy or the execution layer of it?
I enjoy living with the consequences of strategies that I built, being that bad or good. So I think that going from 0 to 80 is something that I like. I rarely do strategies for other ones to execute, and I
Gotcha.
rarely execute strategies that other ones do. So I like to do my own strategy and execute it. That's why I work as an operating partner or as a venture partner, and I don't work as a
Right.
consultant.
So it's the conjugation of the two that gives you the thrill or that gives you the satisfaction, correct?
I think it's a conjugation of the two that makes you learn. So if you only build a strategy and if you don't execute it, you never see what's the ins and outs of that strategy. If you only execute the strategy, you don't know where that strategy came from. And sometimes the why in the fully mode, you don't see it. So if you build it and execute it, that is
I
when I
understand.
think you learn to fail and you learn to succeed. But as I say, failures are mine, successes of the strategy and my execution is from the people that I work to.
Gotcha. Okay. So going back on one of those questions, we had the founder story or the market size, which one mattered the most? And there was borderline hesitation. It feels like it's kind of both. Now, is it both because it depends on the stage at which you're investing, or is it both because one depends on the other or vice versa?
The second.
The way I would present is that I like talking about founder story because I think it's a bit of a tricky thing. Founder story is not, hey, this is how I met my co-founder. It's the first stage of de-risking is, who are those guys? What are they bringing to the table? And are they also aware of the story they're going to have to go forward? So
Yeah.
are they aware of the people they're going to have to hire? Are they aware of the talent they have, what they don't have? And so that's the story they're giving, and also the way they put the narrative together. We're doing this, so there's the founder problem fit, and then the founder market fit, the problem
Thibaut,
market
I
fit.
agree, but all depends on the circumstances. For instance, if you have a founder that's a multiple times founder, you
Yes.
even put cash in his hand or her hand or their hand before the guy even starts doing a new company. Because if he is successful on 3-4 companies, the correlation of being successful in this next company is very high. There's a fund in London that keeps on researching for people that are currently successful founders and try to attain them in a kind of a database in order to understand if they are going to found new things, and makes agreements with them before founding, saying that they want to be they first check if they found new things and give them
Okay.
immediately and nourish them with events, with gifts, etc. There's a huge amount of strategies in that line. But again, that is one point. Another point is a research idea that is transferred from a university. For instance, give you the other type of currency example. A Max Planck Institute finds a new IP and is looking for somebody. So in that case, the founder, the story, you are looking for a more execution credibility. So maybe you're looking for people that had success in 3-4 years in corporate, or 10 years or 20 years executing different type of patterns to place the technology in their hands so they can create and scale it. You need less of that kind of founder typical story that he solves every kind of problem and he beats any kind of adversity. I think that the two are intertangled. The two points are very intertangled. When I look at the company, and I still do this, when I look at the company of the thousands that I looked in my life so far, there's 5 points for me that are super critical, essential. And the founder is one of them. The founder, but it's not maybe the first one. So I look at the company and I look at those 5 points in conjunction as a get together, but I look at the time, the idea first. What type of idea? The idea needs to be interesting. Then the time window that the idea comes. Because for me, it's interesting if the idea is in the beginning of a potential time window or it's in the end of a potential time window. So if somebody in the 2010 was going to found something to sell books online, they were in the end of the time window. Were they going to win in 2010 against Amazon already? 2011, 12. So it's kind of when Amazon was already scaling and ramping up. E-marketplaces nowadays have a very low success, a very low probability of being successful because they are in the end of the time window. And hence, if you have fusion energy, it's in the beginning. Geothermal energy is in the kind of in the beginning-ish, a little bit further but of the time window that it should be on time. So different type of approaches. Then the founder. So idea, time, founder, business plan, and the founding. So the 5 things. So the founder is important because in my view, and this is my personal view, some people look at it in another way. I look at the founder, what capabilities as the founder to do that? Especially because I invest in art-to-bat industries a lot. I need to understand if the founder was not parachuted in and later on needs to be replaced very quickly. Because, for instance, somebody that comes into act from a software industry thinking about that they or she can disrupt the industry inside out and has zero knowledge of the industry itself, for me, it's a red point on the subject. Then the business plan and all the financials that were driven from that, so that there is any notion upon the Tansan song, if there is any notion upon costs, if there is any notion upon where is the product versus the incumbents, etc., or is the product new in the market, where does it position? And then later, the cash that the business has. If it's bootstrap, ideally, if it has a cap table with 20 business angels, 10 funds, and already passed through 20 incubators, and if it is a startup that was created by a studio, by one of those usual suspects that have very difficulty in find success because they join a CEO that was there at hand, the CFO that was there, and people that came through them with the eager of starting something, but in the end they don't know about what they are starting. So all of those things, I looked at them, and if you are in, then it depends on the stage. If the company already comes, and speaking about TRLs, TRL 4, 5, 6, it's a little bit mature. If it comes in TRL 2, it's a different type of eyes. TRL 4, 5, 6 is a different type of eyes. Early stage, see if the company has its first clients. If not, the capitalization of the company versus the costs, etc. So you look at all this, and you know by a fact that maybe you are wrong 1 in 10, maybe you are wrong 2 in 10, 3 in 10, but you know more or less by a fact that that person, if that constellation happens in that idea, it's going to have a highly likelihood of being successful versus the other situation. And then, of course, you place your capital on risk. I think one of the issues that we have in Europe to be bigger ecosystem that we have the capability of being, not as big as the US because they are so much ahead, is the understanding of risk of financial risk and having more financial literacy. How many people in high school trade stocks or understand what's the public market? How many people in university trade stocks in Europe versus the people in the US? How many people risk things, play with financial risk, understands what's exposure of risk or not? In the US, you can bankrupt yourself in the state and open the business in another state. How many people in Europe bankrupt themselves in a country just because they risk a lot, not because they were fraudulent, just because they risk a lot and then open the business in the second country? Not so many. So all of this is understanding risk, understanding cross-border risk. In Europe, that we have that extra layer because in the US they don't. They need to understand state, but that's state taxes, and we have those extra layers. But if we understand better risk, if we understand better markets, Frankfurt, London, etc., the network of potential listings that we have, our public markets versus our private markets, etc., our pension funds. Why our pension funds like this in the US are different? So because we are optimizing for different things than they are, because the UK, Portugal, and other countries give health as gratis, for free. We give health for free to the citizens. And that is an optimization that the US, they're never going to understand. They are never going to understand that. And Social Security, all of that type of subsidies that we have from North Europe, from Central Europe, that's different from the US. So also the population, the diminishing of the population in Europe versus the type of population that they have in the US, type of the ethnical and the character population, the group of age that they have in the US, the old money, where it comes from, the richness, where is it parked? So all of that implies into the market of VC, into the market of what we denominate as risk, because VC is risk capital. No? VC is something that you bet because there's no liquidity and there's no market that you can contrast in. Public markets, you bet. If you lose, you still can take it off with -20, -10, supposedly +10, +20%.
Yeah.
But in
Here,
VC,
there's no liquidity.
No liquidity, no short-term liquidity. You can play the secondary markets, you can play continuation funds, etc., but there's no short-term liquidity for you. So what it means is that when you bet, you need to understand that risk. You need to have that risk profile. You should not bet only to tell to your friends that you are exposed to startups or that you have that. So you should bet with a known risk of what you are doing, that is part of your total portfolio of investments. When 5-10% is in gold, when X is in private equity, one reason or the other leads that the biggest fund in Europe, that's the sovereign pension fund of Norway, is not authorized to invest in private equity. And every 10 years, they go to their board and ask, and the board says no. Even last year, their board said no. They had zero investments, zero exposure to private equity. There is a reason for that. So yeah.
And I suppose this also explains why the common idea that European investors are more risk averse than the US is because when you understand less the risk, you're less willing to take it because you understand it less, and hence
you don't take something that you don't understand. So if you understand risk management, so there is a group of people in Europe, of course, as there is a group of people in China, in the US, in Africa that understand risk management.
Of course.
Because they study it and they understand. But that knowledge should be much more disseminated for other type of characters. Around the world, there's 45,000 VC private equity firms. If those 45,000, they have an average, 5 to 10 people. There's around 500,000 working in the class. But of the ones that working in VC, what is the level of financial knowledge that they have? Because I'm working in this area for 10 years, and when I expose those people that are working in VC on an average European fund to things like debt, and others in blended finance and exposure, half of them turn their head to the other way and walk away because there is no knowledge. So if there is no knowledge in that, the only risk that they take is to pass a check and to pray that 1 in 10 companies is an outlier. It's almost like entering a shop and buying something and you pray that that thing gets vintage so it compensates the other things that you're going to win for the future. It's that type of approach which doesn't leave me so restful into the approach of venture capital. I think in the US, the leverage of knowledge in finance is much higher in every firm. If you talk financial concepts with anybody, and there's the proof is always in the pudding. There's people in the US, there's I see much more people in the US that run cross-class funds that go from private equity, venture capital, they even open an hedge fund or vice versa, because they understand what type of exposure do they need to have and what type of mixed exposure. Tell me in the Europe terms, one firm that opened an hedge fund and went to private equity, or one firm that opened a private equity capital firm and then also other funds in debt, exposure to markets, exposure to this project finance. It's very rare. Must be 3 or 4, 10, or it counts by the ends of the fingers of one hand. There's a couple of them that come from project finance and so on, because then if you come from project finance, you need to understand a little bit more blended the debt. The companies that are invested, then there is a big complaint when you hold assets, especially in deep tech and ag, because you refer to those two sectors, because in Europe especially, because they take too long until maturity, or take too long until, in common language, until they appreciate to a DPI. A DPI approach. It's really, if they are frustrated with that, is because they don't understand that they need to assure that the company throughout their path not only gets grant money, equity money, but they need to push the company as quick as possible to get that, to get different types of approach, to leverage the contracts, to get structure finance if they are in the market, if it's adequate for them, to get factoring, to get all the, but they cannot advise this to the company because themselves, they don't know about these instruments.
So what would be your, I'm going to say solution, as if there's a silver bullet? I know there's no silver bullet, but what would you like to see in the European markets that would make this better? Like, I know in the US, they have things like structures like VC labs or like VC schools where there is education on how to be a VC and teaching more about the finance part and everything. And in Europe, I don't know if there's many of these. Is this something that maybe someone should open in Europe, where there is a financial instruction to people who want to get into venture capitals, into the private capital markets? Is this something that would need to happen? How would you see this improving?
I think a certified investor accreditation in Europe would be interesting.
Okay.
Is not essential, is not the silver bullet at all, but will be interesting to start there.
Of course.
I'm not saying as an exclusion tool, but as an add-on could be very, very interesting, because at least you would know that people all talk at a certain level.
Okay.
Then, of course, the silver bullet of having a sole incorporation in Europe, having the sole taxes for companies, and so on and so forth for funds and companies, that will be amazing. But I don't see it coming because Europe works in a different federation way than the US, and it's going to be very difficult to convince 27 countries because they can opt in or out of different type of policies, especially in taxes.
So and that accreditation that you're talking about would be a bit like a CFA, where there is a modulus, there is things to understand. And well, of course, there's a silver lining. We talked about silver bullets. Now there's a silver lining, of course, which is who certifies that? How do you trust that body, especially if it's a monopoly? And there should be that. And I think another thing that is, it's how do you conjugate the financial knowledge with the operational knowledge? Because you also have financial people that come in and invest in startups and they've never done the operational part. So maybe having one that is a certified in finance, so a certification to invest, and one which is the operational knowledge of having done.
Yeah, but
once you conjugate both, that could be interesting.
Yeah, but I think at least for people that are GPs, I'm not saying if you are a principal, but for people that are liable at a certain level, that are taking the last decisions, that should be a fact, because that would lead more concentration of knowledge and a push back and to understand different concepts. The intention here would be, I'm thinking about people in my head, and I've just questions that I make sometimes. And if they understand this and they say no, and I see that the way that they say it, it's like no, and we don't care. And I wonder, so what are you doing here? You are only in VC because basically it's a fast way to get rich. Do you think it's a fast way to get rich? How many funds do you think there are in that quartile? So you are living what, on management fees? So it's an avoidance in the seriation on the market. Basically, I would see that more expert operators will come in, and there would be a more high level educated talk between the operators than it is now. But that would have to stretch also to different levels. That we need to be structural.
Gotcha.
And yeah, I'm not an amazing person to solve structural items, but I can help strategize it and then participate in the implementation. But yes, I think something needs to be done because especially it's not that there is fraud. I think there is no fraud because where the fund is incorporated, being in Luxembourg, Switzerland, Germany, Portugal, there's a control of certain items. But the people behind what is being done rely too much on thirds, rely on the fund manager that they externalize, and the expertise of those people then, what is it? It's just they are there playing from one side to the other. So for me, it's something that it needs to be fought in different ways. Otherwise, we will keep on having these issues. In my opinion, and just to finalize, with AI, I preview, because the cost of access and so on are going down, that in 5-10 years, half of the firms in Europe are zombies. The VC firms in Europe potentially are not going to raise the third, the second, or the fourth stage because they don't make sense, because they were raising for SaaS and now they need to transform to AI, or they really don't know how to evolve this, because also the fees, the traditional 220 model needs to be revised. The investors are tired of that model.
It's a big thing that's been in the discussion of so many of our episodes. So I'm really glad you're bringing this on, the whole VC model being broken, the 220 model being broken. And there's a lot of innovation in what I've been calling lately venture capital tech, where there needs to be innovation on what goes behind the funding, novel models where maybe there are ways to introduce cash flow in the VC ecosystem, in the investment ecosystem.
Totally. You see what's happening now in Africa. The new funds that are present in the continent are all blended funds, third wave funds, 3-4 layers with first loss capability, with junior masses and so on, different type of approach. So the expertise that you have to manage such an instrument at any level of operations that you do is much bigger, and the analysts are not there anymore. The analyst layer. So you need to enter, you need to learn the métier through doing it. You cannot learning in the office, basically. So you need, there's another point that I'm not in favor, I'm not against, but we need to try to find new ways of getting people into the job and demystifying the job. Because the job is not very complex. You just need to have a crossover of experiences, or you should have a crossover of experiences from constructing, from running businesses, from doing the sector. That should be almost obligatory to have. It's a pain to see people investing in, for instance, in ag food that don't know how business in ag food operates. It's a pain to see people investing in energy that don't know how business in energy operates in certain areas. So
it's a bad thing for the ones who know, because the ones who know might get lost in that signal, and the LPs get a bad vision of that sector and decide to completely move away from it because of those worse signals.
You price companies wrong, and you act in the companies in the wrong way, and you act in boards in completely disparate activities. You let yourself govern sometimes by twisted founders in boards, and whoop-de-whoop, you are in Series A, B, and the company is completely a meltdown. When you arrive, it maybe could be a good company, but then you need to change governance. And when you enter an AB, because the company is completely turned upside down. There's ins and outs, and this is there are things that can do to change. And there are things that I don't think they are going to change anymore, because people that are inside are ready to stick to their habits, and they said, we did a lot, we don't want to continue to learn and improve and do new things, because sometimes you really need to reset yourself and start almost from scratch. And that's what when you are prone on innovation, you change when you are on top, you don't change when you are on the bottom.
In a way, it's going to naturally occur, as you said. If in a couple of years some firms become zombies, then the ones who survive will be curated, and the ones who died will have yielded learnings to curate the whole cycle. It's a cycle. So in a way, you could be worried. If I'm an LP right now, I'm a bit worried about the state of what's below.
But whatever you tell to people Thibaut, whatever you tell to people, never ever they are never going to say yes. You see, if you tell to people that AI is coming, disrupting your jobs, you are more prone to that because you work for a SaaS company. or you are the sales manager of a SaaS company, potential AI is going to, or the lead generation AI is going to, it's kind of let it be. So instead of already previewing that and transforming themselves into something that it costs work, that they need to be in doing that transformation before it arrives, they wait until the last moment and then they crash. And they say, oh, I was fired. And now, what's the next thing? And there's a lot of saw it coming, but people don't want to move. And in VC, there's a lot of that. Sometimes because they don't know how to do differently, because they are too entrenched with eating that 2% or that diminishing 2% of the fee. If you start thinking, it's a good deal. So you raise cash from an institution. You are a fund. You raise cash from an institution. You get 2% of the fee. The institution agrees that you get 2% of the fee for the life of the fund. The fund normally has 10 to 12 years. So you are 12 years with a guaranteed wage that nobody can take out of you. Whatever happens after that, but those 12 years, if you are, depending on the stage of your life, if it is big enough, think about it. It's something to reflect.
Speaking of things to reflect, you mentioned something very interesting, which was, and I had a question in there. I actually forgot to read it. It was about AI, excited or afraid of it. And you said the main thing is to being able to anticipate the future and anticipate the change before it actually affects you. Now, within your job as a fractional operating partner and supporting those funds, what have you done and what do you do that you believe AI cannot replace and that makes your core competencies so strong in a way and so resilient to change? Is it the human aspect? Because that's often one thing we hear is, hey, are you scared of AI? No, because I do something that I believe AI will not replace. And often this boils down to the human part. So the access to people, the networking, the understanding of the team of founders, of GPs, for example. And is this what you think makes you unique in that sense? What are the ways that prevent you from this whole AI transformation? How are you adapting to this?
I think it's a good question. It's a good question, and undoubtedly, you need to reflect upon that every day. Not be afraid of it, but at least reflect upon it and think, how can you keep your momentum? I think that I usually said that there were three factors that humanly were very important to interact. When I give classes in university, I mention this quite a lot. So it's and this was before even the big wave of internet and during and now with AI. So it's a crossover of information that you acquire, experience that you have, and common sense that you put in your actions. I would join something to these three packages that I think that composes the fourth that I would say that's creativity. If you have a little bit of creativity, if you have a lot of common sense, if you try to strive for information within your areas of activity, information you compete totally with AI. If you have some accumulated experience in that, I think that's something that you can gain from AI because you committed a lot of mistakes. You make things well, things are not well, so you were not afraid. What I call soft skills. So there is functional benefits and there is non-functional benefits when you construct a market plan. No, there's functional benefits that mean that it's something that your product or your company can do. A car can go 100 kilometers an hour. It's a functional benefit. But there is non-functional benefits. That is, your car can give you a feeling of safety. If I talk like this, you think what? You think Volvo. So that's a non-induced functional benefit. So I think the non-induced functional benefits that you can generate, and if you control them into a group of factors that you can apply, focusing on a couple of different things, and you can say no more than you can say yes. So you can say no either to contracts, either to areas of activity, either to things that they look great, but you are going to say no because either you don't know them yet, maybe you say yes in the nearby future, but you are going to say much times more often no than yes. Then I think you create a package that you can subsist to the constant waves of innovation
And you can also be better because if you in parallel work with AI in the right angles that you have, not let yourself flabbergasted with AI this, AI that, but work with AI in the right points that you need them to work for you. In my case, I think it's all about time. If I can make AI give me time back, it's amazing. As I said, as a fractional fund manager, I have several contracts. If I can have more contracts, then
More
because AI
fractions,
can
basically.
have more fraction, because AI can optimize some of the tasks that I do even better. I need to sleep certain hours, but on the rest of the day, if AI can optimize tasks that I do either at the personal level, either at the professional level, incredible, amazing. And that's what I'm trying to understand step by step. I'm not a fanatic. I'm not an idealist about it. I'm open to every kind of usage of innovation.
Gotcha.
But I trust my capabilities as well. So that's on top of it.
You tapped into something that is extremely funny in the sense that, again, we're going to bend the time a little bit. I recorded just before this episode, so this will be episode 8, if I'm correct. And the episode I just recorded will be number 22, because there's a bit of a mismatch in the recording. And that was with Chef. Chef he's an angel investor based in Albania. And one of the key teachings he was giving was, especially as an early investor, you need to learn to say no. And you need to learn to say no for quite a long time before you understand, and then you start investing. So there will be some good deals that which you have to say no, and you have to save time. And it was about this time efficiency and the asymmetry. It was interesting. We had this discussion on the asymmetry of time between, in a startup, things need to happen fast. Innovation happens fast, and one thing that you want to see as an investor is the pace at which you improve your product, you can get to the market, etc. So it's all pushing time to go faster. But on the investor side, it's how do I make the most out of my time? How do I say no? How do I slow down and reflect? And maybe this is where what you're saying. This is where the AI allows you to take some of that time, allow you to reflect, and not be in this constant rush and making hasty decisions. So it's fun. If we're discussing the same thing, our audience will hear it with a month and a half of disparity, but it's a good thing. It's good. It will be a good reminder in a couple of months to hear it. So
I think those things have to do with common sense and with, again, the path of the people through life. When you arrive to a point that you are well with yourself, you don't need to prove nothing. And actually, I prefer that, again, point that I just mentioned 10 minutes ago. I prefer that the other ones that for which I work or I work with get all the merits. And if there is something to blame me, because I did the strategy and I did the execution, but the other ones get the merit. I prefer in that sense that is much more positive. I don't need to appear in the news. I don't need to do posts. I don't need to do anything. I rarely do those type of things. I'm out of social media. So I think that I learned that humbleness brings more success than any other thing. And this is, I learned through working 15 years in a company that is like that. And that is there for 170 years. And that I praise a lot, that company. But again, you cannot expect everybody to be like you. You have to cope with people that are completely different. And while coping with these people in different phases of their lives, either they are growing up, ambition to be rich, to do that. The only thing that you want to have is to have a very quick filtering capabilities that you know that you have to work with them, but you don't want them too much on your surroundings because they will not also facilitate, either you facilitate their growth, either them facilitate my growth, because I'm that type of person that I'm learning until I go on the horizontal I learn every second. I learn with you. I learn with everybody that I interact. But if I feel that the person don't have, because I interacted with them once or with somebody that works, nothing to tell me, I'm also going to shut up for that entity or that person, because I'm losing my time. Because again, time is the most precious thing that we have.
absolutely,
We live until later nowadays. But again, time is whatever you like to do it or not. Time is the most precious thing that you have, and you cannot buy it back.
The only thing that is certain is that eventually you will end up horizontal. Is the only thing that is certain at some point. So Speaking of time, I'm also conscious of our discussion. It was really interesting going maybe a bit deeper in those topics, the topics of finance, the topics of how to perceive your own value addition, how to manage your network. It's something that is at the core of course, what I'm trying to do, what we're trying to do with Fundraising Insiders. Now I'm addressing the audience, of course. This will be a bit of a longer episode as usual, as per the usual, but we also do a lot of work to boil this down, to take the extracts, the highlights of those discussions, and we will have them hosted on our repository. At the time this episode will be posted, I might either be spending all of my cloud credits building it, or it should be live very soon because I'm building it at the moment. But that's the idea we also have, is not everyone has the time to listen to 50 episodes, but there are for sure learnings, wisdom from our guests, who I thank you, Bruno. I thank all of the other guests who've been on the show, who will be on the show, who share their wisdom, 10, 20, 30-year experience. And if we can find a way to make this easily accessible through the repository website, through our LinkedIn post, when we post the podcast, we say, hey, a new episode is out. But we also put all of the key learning. So I'm really looking forward to get to the editing of this episode, distill all of those learnings and get them out there to the ecosystem. And I really hope that, especially what you said about Europe, making it a better ecosystem, that we can work towards this. So again, Bruno, thank you so much. I know we changed a little bit the structure of the episode, and then it's going to be my job to stitch it all together. But there was very, very insightful bits here, learnings that we haven't tackled anywhere else in any other episode. And I really appreciate you being open on certain things and really transmitting the passion. The fact that you go so deep in certain topics, I can see that you really want the European ecosystem to be even better, to break those borders, to bring the knowledge, and that you're willing to help
it's
the
not
others
only Europe.
teach.
It's not only Europe. We want the global ecosystem.
Of course.
Although we live in Europe, but I think that I do a lot of work in Africa currently. I did a lot of work in Asia. I did a lot of work in Latin America. I would like every ecosystem to bloom, and every ecosystem has its own problems, and we can talk about them in different episodes. But I think that because we are in Europe, you are in Switzerland, and I am currently in Germany, we need to talk about Europe in a different way. And yes, Europe, undeniable, has issues and structural ones. But anyhow, it was a great pleasure to be here, an amazing pleasure to be here. And I'm looking forward to hear the final result, to continue to talk with you about other subjects as well. Okay?
Of course. Thank you so much.